Welcome to another Oceanside chat for our Summer Smasher 2021 program. This week, we have someone very special, Aaron Fyke. He has been working with the Thai office at Viterbi for a very long time. He came very well recommended. He comes from the Cleantech space. He's also done our synchrotron program. This is not his first Summer Smasher. I will let Aaron introduce himself at length, but I just really want to thank you, Aaron, for joining us today. I can't wait for your presentation.
No, that's perfect. Let me get this started and that guy, and then I go over here and share. Okay, and this is in the wrong. All right. Okay, that worked reasonably well.
Great.
Hang on, I'm going to move. I tried something which was a mistake. So let me cancel that and put something on a different monitor because it turns out you can't change it after I, here we go. Let me move that.
These are the joys of being a really good presenter.
Yeah, I have multiple monitors and I totally fell on my sword trying to do something clever. Okay, let me do this.
It's always nice to make mistakes when you're doing something clever versus just a boneheaded mistake. So
yeah,
there you go.
There we go. So, okay, so that's playing. That is, okay, this is completely off the rails. Why is it not working? Sorry, just one more thing.
Don't be sorry. I want to shout out Naveed and Michael and Laurie for introing themselves in the chat. Again, it's a very smart thing to do, guys.
All right, let's do the old standby. So yeah, let me get, all right, here we are. All right, well, you know what? I'm just going to do this anyway. Share screen. Where should I talk? Okay. All right, that is working. So we'll go with that. The great surprise was that I should be able to have notes, which are not easily seen, and I'm not sure why that is. All right, they were literally here a second ago and they're gone. Okay, that's fine. I can certainly talk about this regardless. So what I want to talk about, my name is Aaron Fyke. I'm the founder and managing partner of Thin Line Capital. As was said, I gave the synchrotron program back in 2017, and then was involved with the Summer Smasher program did a Summer Smasher event back in 2017. But a lot has happened with me getting Thin Line Capital going and a variety of other things. So I wanted to talk about that entrepreneurship experience, but I also really wanted to talk about the story of Cleantech itself, both as an investment thesis and an asset class. And because it's had a really interesting history, which has basically been the foundation of my career, but it's really just getting started. So that is what I want to discuss today. So one of my first jobs was with a company called Ballard Power Systems, which made fuel cells for electric cars. And I call this era Cleantech 0.1. This is from 1995 to 2000. And it was really just Ballard. There wasn't a whole lot of other interest in what was considered, clean energy, but nevertheless, Ballard itself attracted an enormous amount of investor interest. And it was really the first time that investors had paid attention to this space. There's an overarching theme you will find as I discuss the history of Cleantech. And it's generally one of great excitement and then great disappointment. And I want to demonstrate that here. So this is Ballard's stock price between up until just after 2000. And Ballard at the time hit a $32 billion market cap, which just for context was almost 10% of the value of Microsoft at the time and over twice that of Apple at the time. And the reason was that everyone thought that Ballard was going to become the Intel inside for the automotive industry. Every single car was going to be running off Ballard fuel cells. Automotive emissions were going to be a thing of the past. And just the excitement about the market size really propelled Ballard to these valuations. It was also caught up in the excitement of stocks just in general, 1999, 2000, which is the dot-com era, which I'll talk about a little bit more later. But what happened, unfortunately, when the dot-com bubble burst, it dragged down the rest of the stock market, taking Ballard with it, to the point where they've never actually been able to recover to the highs that they had at that time. So I left Ballard in 2000 and went to MIT for grad school, and then began exploring what what eventually became the second phase of Cleantech. So Cleantech 1.0, I would think, happened really between 2005 and 2008. And this period was actually called Cleantech. And just like the Netscape IPO really was, kicked off the dot-com frenzy, and Google's IPO kicked off what we call Web 2.0, it was really the IPO of SunPower as an extremely efficient solar cell manufacturer that kicked off the excitement of what then became Cleantech. And just like Ballard's story, however, in this case, it was the 2008 global financial crisis, which was started because of the mortgage crisis, which I'll also talk about a bit later, that caused a decline. And this is a pool of aggregate stock prices for Cleantech companies called the Wilder Hill Index. So that was the end of Cleantech 1.0 in 2008. And goodness, there we are. So this next period I call the long winter. And if you were starting an internet company and the world fell apart with the dot-com era in 2000, 2001, you really only had to wait 2-3 years. By around 2004, things were picking up again. But that really wasn't the case with Cleantech. It collapsed in 2008 and took a very long time to recover. So during this time, I started a number of companies. Soliant was a concentrated photovoltaic company that I started and joined in 2006 as one of the founding members. Starfish Ventures was a venture capital firm in Australia, Melbourne, Australia, where I was investing in this. And then when everything fell apart, I returned, joined the X Prize Foundation. And there I discovered there were opportunities in energy storage, which led me to start Energy Cash. As the founder and CEO, I co-founded MicaSense, a drone agriculture company. And then when Energy Cash ended up winding down, I became the co-founder and CEO of Heliogen. I got involved with a Hong Kong battery storage company called Amped Energy. And then in 2017, I was part of the founding team for Energy Vault, which was a reboot of some of the things that we had discovered at Energy Cash. But around 2017, I noticed something was changing, and there were a number of companies getting started in this space, and there was a lot more excitement in this space, but it addressed a number of the concerns from 10 years prior. So with that, I started Thin Line Capital, a venture capital firm to invest in the space. And this is what has happened since. And so I really call this era Cleantech 2.0. The name Cleantech is somewhat maligned because of the disappointments that happened the first time around. Sort of like you never hear people talk about dot-com companies anymore. And so Cleantech has a number of names: Climatetech, energy sustainability, circular economy, clean energy, and a variety of others. But this whole space is so much bigger than it was before, and there's a lot more momentum behind that. So these are the companies that I founded or co-founded, or people that I've invested in or had invest in me. And so these are the reasons that things are different this time around. As I said, I've showed pretty compelling story of lots of excitement followed by lots of disappointment. Okay, so why are things different? Well, the main thing is that the reason everyone was excited the first time around is that the size of the market in the energy space, transportation, electricity, building infrastructure, all these things, they're it's measured in the trillions of dollars. People were excited about the internet because it was multi-billions of dollars opportunity, whereas the energy system is the multi-trillions of dollars opportunity. And the thing is, when things stay the same, that favors the incumbents. They have all the advantages, they have the brand, they have low cost of capital, they have distribution to the market. But when things are changing, that favors startups. And with the internet, that change disrupted the telecommunications industry and allowed startups to really flourish. And so we're seeing the same thing happening in the energy space, but the size of the market, partly because of population growth and the world becoming wealthier and the demand for energy increasing, partly because of the stresses of climate change to decarbonize and move to a zero carbon economy, and partly just because the infrastructure debt, at least in this country alone, of huge investments that were made decades ago that haven't been followed on. There's about $1 trillion required for the energy industry. Those are all strong drivers that support new startups in this space. But the major difference is that these companies now require much less capital than the first time around. So 10 years ago, most clean tech companies were extremely capital intensive. They were large solar installations out in the desert. They were biochar reactors or big biofuels refineries. And the reason for that is that these markets didn't really exist. People were taking venture capital dollars and using them to try to build out whole new industries in solar and wind and electric vehicles. And the reason that happened is that the VC industry was used to building out new industries. That's what they did with internet search. That's what they did with social media. But that works well for industries that don't exist at all. But the energy industry does exist, and taking venture capital dollars and trying to build out these industries was not the most efficient way to do it. And so what has happened now, though, is that the solar industry is big enough, the electric EV industry is big enough, the wind industry is big enough, battery storage, these markets exist on their own. So startup companies can be created to sell into those markets rather than building them out. And that's a much better use of VC dollars. And so there are many more opportunities than existed before. And so I'd really like to describe the difference between what happened before, what happened in the dot-com era, the collapse, and then the growth of companies like Google and Facebook and Netflix and Amazon, which was a pre-dot-com company that boomed post-collapse, and compare that to what we're seeing in the clean tech space. So 95 to 2001, internet companies see an incredible rise and fall in valuations. It's a period of irrationality and hype. The reason for this is there were strong drivers for growth, connecting everyone in the world. There was huge market potential. There was a lot of excitement. Companies were building out the internet, both in terms of actual users and physical infrastructure. There were a lot of crazy companies burning cash, and many inexperienced investors went into the space and then were forced out. So what happened next? Well, after the crash, many companies then came and built on top of these existing networks and users that were existing. They found new opportunities to serve that user base that didn't exist before. And there were much more capital efficient paths to market. At the beginning, if you wanted to even host a website, you needed to physically have the machine running. Whereas now you can rent server space. AWS, Amazon Web Services, is a hosting platform. Software as a service is a really capital efficient business model. And so the result was that 2004, 2005 was the time to return to internet company investing. If you look at clean tech, 2003 to 2008, these companies seeing an incredible rise and fall in valuations. It's a period of irrationality and hype. It was because there was a strong driver for growth, the world's energy system, multi-trillion-dollar markets, lots of excitement, and companies were building out energy infrastructure, both in terms of users and hardware. There were lots of crazy companies burning cash, and there were a lot of inexperienced investors who entered and then were forced out of the space. But just like before, now companies can come and build on top of existing installations and users. They're finding new ways to serve this user base that didn't exist before. And there are many more capital efficient opportunities that leverage existing deployed capital. And so the result of that is now is the time to return to this space. And so with that, I started Inline with this investment thesis that opportunities exist for low capex investments into companies that leverage existing installed capital base as the market moves towards a zero carbon economy. Or in very short, one sentence phrase, I want to invest in companies that I wish I had started. So that is basically the history of my experience with Cleantech and the rationale for starting the fund. And I've partnered with a group called Climate Reality Project, and I've used a bunch of the slides related to that for the rest of this presentation. So you'll see an abrupt shift in the graphic design. But I want to talk about the reasons I'm really excited going forward. And you should be aware of the fact that I haven't updated some of these slides in a couple of years, and certainly not since the pandemic. So in many ways, the things I'm telling you are actually even stronger than what it shows in the slides. So with that, let's jump in. So in October 2014, Mark Carney, the governor of the Bank of England, says the vast majority of carbon reserves are unburnable. And what he means by that is that we are overburdened by subprime carbon assets. And so here, this circle represents all of the CO2 emitted from burning fossil fuels since 1850, roughly until now. You can think of this circle as the total emissions of industrialized humanity, 1,800 gigatons of CO2. By the way, 1850 was the year that we discovered that CO2 traps heat in the atmosphere. And this little circle here is what was burned roughly in the last 15 years. Now, this circle, 2,800 gigatons of CO2, are the proven and probable reserves that companies, countries, and states have for oil, gas, and coal companies on the books. So the stock price of a fossil fuel company is determined by its proven and probable reserves. Most companies' stock price is a function, some multiple of their earnings or revenue or growth. For fossil companies, it's mostly based on what they've proven they have in the ground, because the assumption is, of course, that if they have this much oil in the ground or gas or coal, they will one day extract that and burn it and get paid for it. So that's 1,000 gigatons of CO2 more than we've emitted for all of humanity. And this circle is the amount that we could burn while still maintaining, avoiding catastrophic effects for climate change. If we burn this amount, that will give us a 50% chance of staying below 2 degrees Celsius. So you can see what's remaining that we can burn is roughly equal to what we burned in the last 15 years. So when you hear people like 3 or 4 years ago saying, we've only got 10 years left, this is basically the calculation that they're talking about, with slightly more aggressive factors. Rather than a 50% chance of less than 2 degrees, it's a higher chance of saying less than 1.5, but that's where that comes from. And the rest is unburnable. So that's $22 trillion. So what happens to the global economy when holders of these assets who think they're worth something, they think they're worth $22 trillion, find out that they're actually worth zero? And so that is the subprime carbon bubble. So what I wanted to do was compare that to the subprime mortgage crisis. So remember, in 2008, there were a whole bunch of mortgages that people thought were worth something that were actually worth zero. And then when that was discovered, there was a run on the bank and a global recession and the biggest economic collapse since the Great Depression. Well, if the subprime losses of the subprime carbon bubble are $22 trillion, the total amount of losses from US underwritten assets for the subprime mortgage crisis was $2.7 trillion in losses from the mortgage crisis, which means the economic time bomb that is waiting to go off as by sticking with fossil fuels is 10 times bigger. And so because of that, the last one holding the bag will be the ones will lose money, a number of very large funds, including the largest sovereign wealth fund in the world, Norwegian Sovereign Wealth Fund, are shifting to diversify entirely away from oil and gas assets. And so that has caused the following economic effects, which I'll talk about further. Because of that, in July of 2019, BP's head of strategy admitted that some of its unextracted resources, quote, won't see the light of day. And because of that, if we look at the S&P 500 going back to 2010 and compare that to the S&P 500 energy index, we see Reuters saying that energy has been the worst performer since the US bull stock market began more than a decade ago. And Exxon's returns on investor capital have continued to decline. If you look at BP, in August of 2020, last year, they announced that they would cut oil and gas production by 40% and increase spending on low carbon investments tenfold by 2030. And I've got some other logos to show you here. This month in June, I mean, it's the third week of June now, so it's been a pretty big month. But the first week of this month, a Dutch court ruled against Shell, found that it contributed to climate change and ordered it to cut their emissions 45% by 2030 compared to 2019 levels. And Exxon had a seismic ruling. A small hedge fund called Engine Number One secured enough votes to put 3 people on the oil majors board pushing for cleaner energy. And so with people moving away from the fossil industry, there's been an explosion of investment in clean energy. And this chart, by the way, only is 2019. It doesn't even include the effects of Biden administration's pledge for several $trillion more investment into clean energy. And the reason for that is basically up to since 2017, clean energy companies have seen, and this is the chart I showed you earlier with the spike in stock prices, returns of 60%, whereas fossil fuel companies have gone down by 12%. Now, there's been an enormous boom in fossil fuel companies tied to the recovery of the pandemic because of the huge surge in activity, which has been coming out of lockdown, but the overall trend is still the same. So I'd like to give some background of why this is so exciting, because a lot of people don't really realize how much has happened in such a very short period of time. So back in 2000, the thought was, well, how big could wind energy be? And the projections were that worldwide wind capacity could reach 30 gigawatts by 2010. That seemed to be a very reasonable prediction. But the reality was, by 2019, that goal was exceeded by a factor of 22 times. And you see the exponential growth in wind energy capacity around the world. And the reason, so before I get into that, there's a really great headline here. Greentech Media published that wind is set to surpass hydro as the #1 US renewable power source in 2019. Now, I don't know if you know this, but there is a lot of hydro in the US. 300 million megawatt hours a year generated in the US just from hydro alone. And to put that into context, California's energy consumption in 2018 was 285 million megawatt hours for that year. So basically, there's more hydroelectricity than the entire consumption of the state of California. So that's a lot of electricity. But the headline for the next year was that wind has surpassed hydro as the most used renewable source in 2019. The wind installations are just exploding. And the reason for that is declining cost. Back in 1984, it was something like roughly 200, this is measured in euros, but 200 euros per megawatt hour. And now it's down below 10. And so I did update this slide. In 2020, the US had 125 gigawatts of wind energy installed, which is enough to power 37 million homes. But I really want to turn to the UK because there's some really amazing things happening. For the first half of 2019, Scotland produced enough wind energy to power all of its households almost twice over. And the UK generates more than 3 times, in 2018, they generated more than 3 times as much energy from wind as from coal. But in 2019, they generated more than 18 times as much electricity from renewables than coal. And so this story plays out brilliantly over a couple of years. In April of 2017, Britain went a full day, the first full day with no electricity from coal. And that's the first time that had happened in over 130 years. So in April of 2018, they went 3 full days. And I really love this. Let's see what happened in 2019. So if we turn back, the Manchester Guardian published in 1956, Britain will fail without coal. There's a need for investment. But May 31st, 2019, look at this headline. By the way, same newspaper, it's the Guardian. Great Britain records 2 weeks of coal-free electricity generation. And then May 19th, 2020, Britain went the first month with no coal electricity from coal, and then all remaining coal plants to be shuttered by 2025. So people say the energy industry moves slow, and it generally does, but let's review. In 2017, 1 day without coal. 2018, 3 days. 2019, 2 weeks. 2020, 1 whole month. And by 2025, no coal will be burned in the UK. These are enormous changes that are happening extremely quickly. Globally, there's enough wind to supply worldwide electricity consumption 40 times over. So I'd now like to turn to solar, where I know the solar industry much more, but we see the same story there. So back in 2002, the projection was the solar energy market would grow, 1 gigawatt a year by 2010. But the reality was that goal was exceeded by 17 times. And by 2019, it was exceeded by 121 times. And so it's the same story. You see this enormous exponential growth of solar installations. And the reason for that is exponentially declining costs. $80 a watt is what solar costs in the 70s. It's down to 20 cents a watt today. And so the US has almost 100 gigawatts of solar energy capacity, which is enough to power 18.5 million homes. But it's not just the US or other developed countries. What's really neat about solar is we're seeing what's happening in developing countries. So just like with the telephone, landline telephony was basically leapfrogged in the developing world, going straight to mobile phones. And there are many areas without a built-out electricity grid where pay-as-you-go solar, which has low initial costs, and areas without grid access can have electrical access by using distributed solar, and that is just exploding. But I really want to give you one example of the kind of market uptake we're seeing, and Chile is an incredible success story. So their solar market started slowly. At the end of 2013, there's 11 megawatts, then 1.1 gigawatts, and then 2.3 gigawatts at the end of 2018. However, this is what is happening in Chile now. There are over 16.7 gigawatts of solar projects approved or under construction in Chile, and there are many other areas of the world where this kind of growth is possible. Every hour, enough solar energy hits the earth to power the world's energy needs for a full year. Now, I really like this framework. I heard this from my co-founder of Energy Vault, Bill Gross at Idea Lab, and he really put this together well. We basically will replace fossil generation worldwide from the electricity grid when these 3 tipping points have passed. The first is that when renewables are cheaper than new fossil generation, when it is cheaper to build a new wind farm than it is to build a new coal plant, factoring in financing costs and maintenance and cost of fuel, etc. We've passed that. The second tipping point is that when renewables then become cheap enough that they're cheaper than existing fossil generation, where it is literally cheaper to build a new solar farm than just to shovel the coal in an existing coal plant. We've passed that. And the third is when we get incredibly cheap grid scale storage. Renewable energy is the cheapest form of general energy generation in the world today. Where fossil is used is for balancing out the variability that comes from renewables, and primarily natural gas for that matter. So this is where storage can play a real role. So let me focus on each of these. Let me start with renewables cheaper than new fossil generation. So this chart shows the cost of clean energy technologies in the US from 2008 to 2018, over that 10-year period. Now, 2008 really wasn't that long ago, but since then, so many things have changed. Residential PV dropped 55% in cost during that period. Utility scale PV was 71% cheaper. Wind dropped by 75% in cost. So this isn't a 10 or a 20% cost reduction. Wind is literally a quarter of what it used to be. EV batteries are almost 80% cheaper, and I'll talk about the effects of that a bit later. And LED light bulbs, which went from being a sort of a unique one-off niche application, have exploded and are everywhere. And that's because they dropped in cost by almost 94% over a 10-year period. And so the result of that is this headline. Bloomberg published that the cost projections to meet the commitments under the Paris Agreement are actually now $10 trillion cheaper than was anticipated due to the incredible declining cost in renewables. So the cost of meeting the Paris goals are now $10 trillion cheaper than anyone thought they would be, and the costs continue to decline. The second point, renewables cheaper than existing fossil generation. I really want to walk you through what's happened with coal in the US, for example. These are the coal plants that were proposed to be built and were defeated. It didn't make sense to build them at all. These are the ones where they were forced to retire, and these are the ones where the retirement has been announced. All of these coal plants have been canceled. Coal is going away. By February 2023, the US is expected to retire another 19 gigawatts of coal-fired generating capacity, and in the same time frame, they will add almost another 200 gigawatts of solar and wind generating capacity. And now I want to turn to incredibly cheap grid-scale storage. As I mentioned earlier, Bill and I were co-founders of a company called Energy Vault, and we're really excited about the potential for providing incredibly cheap grid-scale storage. And the reason for that is the following. Here's the historical storage market. And yet hold on to your hats, because this is what is coming. As the entire grid moves to renewables, there'll be this massive uptake in storage to balance out and allow for a zero carbon electrical system. And that is going to make an enormous opportunity for storage, in addition to what's happening with electric vehicles. So, and I'll talk about electric vehicles in a sec, but why is that happening? It's the same story as solar and as wind, as everything else. And that is because of massive reductions in costs. Lithium ion battery prices were around $1,200 a kilowatt hour back in 2010, and they're basically closing at $100 today, which is why Bloomberg published that solar plus batteries is set to begin a dramatic transformation in human civilization and completely changing the grid. So that's the electricity grid. What is happening with electric vehicles? And it is exactly the same story. Electric and hybrid vehicle batteries were around $1,600 a kilowatt hour for the entire pack back in 2000. And the chart says $200, but I know for a fact that that's actually closer to about 70 bucks today. And that's an astonishing cost reduction in the cost of electric vehicle batteries. And so why is that? Well, batteries are basically, and their entire supply chain and materials, are just huge volume-based commodities gains. As the scale increases, costs collapse. And I think this is really fascinating. So in October 2017, the number of lithium-ion battery megafactories under construction globally was 17. The Tesla Gigafactory that everyone talks about was one of those 17. So already right there were 16 other gigafactories under construction around the world other than the Tesla Gigafactory, although people tend to know only of the Tesla Gigafactory. However, as of 2019, that number stands at 70. There are 70 factories under construction the size of the Tesla Gigafactory of that scale. So battery prices for electric vehicles are going to collapse. And so the result of that is if you compare the costs of powertrains for, this is an efficient fossil fuel powered car with that of mainstream electric cars, the lines cross 2023, 2024. So between 2023, 2024, you will be able to purchase for equivalent cost parity an electric vehicle over that of an internal combustion engine car. And that will be the beginning of the end of the internal combustion engine. And I'd like to walk you through how this scenario is going to play out. So ICE means internal combustion engine. So the way this thing will work is first EVs, their range will be limited. Then EVs will be more expensive than ICE. And then EVs hit price parity with ICE. This chart shows that happening after 2020. It's the 2023, 2024 timeline. Is what I mentioned before. Then EVs become materially cheaper than internal combustion engine cars. And then owning an internal combustion engine starts becoming socially unacceptable, like smoking. Oh, and by the way, Norway is currently here. Then ICE leases become 50% more expensive than EVs because the leasing company doesn't want the vehicle to come back because then they won't be able to sell it. Then leasing an ICE becomes impossible. And then ICE residuals start trending towards zero. Now, this just one other thing I want to mention. When I said Norway was here, that was true in 2017. In actuality, Norway in 2019 was here, and currently Norway is here. Almost 80% of new vehicle sales in Norway are electric vehicles. And so these are all the auto manufacturers that are moving towards electric vehicles. This is where all the R&D is going, is into the EV supply chain performance. Very little proportionally is now being spent to try to continually improve the internal combustion engine. And so an effect of this is that 35 cities have committed to only buying zero emission buses starting in 2025. You see Los Angeles on the list. But what's particularly interesting is Shanghai and Shenzhen in China. They're already only buying electric buses. So that's why I'm particularly excited about this space. But I wanted to talk about entrepreneurship because this is the journey that I've been on, and there are a couple of things I wanted to share with you. The first is you don't necessarily need to know what you want to be. It's more important to follow what's interesting to you. So when I knew I wanted to be involved in clean energy back in 1991 when I was doing undergrad thermodynamics, but I didn't know that I wanted to own my own VC firm. You know, back then I couldn't even spell VC. I didn't know I wanted to be an entrepreneur. I just knew that I wanted to continue searching for opportunities that would let me learn as much as possible. And to give you some context of that, I had a pretty strong interest in computer science, and I graduated right literally at the birthplace of the internet. And I still didn't pursue that. I pursued, you know, clean energy because it's what I wanted to do. And so, you know, it isn't always about what's hot, and the path to what you end up doing isn't always straight, and that's totally okay. And the second thing I think is important to mention is, you know, is be prudent. Put yourself in a position that will allow you to grind through the hard times. So a lot of people say, as an entrepreneur, you know, you have to have passion, and you need that passion to be able to grind through the hard times. And while it's true, you do need to have passion in what you're doing, that's often not enough. It's often smart to give yourself the support so that you can grind through the hard times. You know, it's important not to raise money too early. An example of this is that when I was getting Thinline going, I, you know, found a number of side consulting jobs, writing grants, doing things like that. And what that allowed me to do is make sort of enough money to pay groceries or keep the ship afloat. And therefore I could take as long as I wanted to try to get Thinline off the ground. I wasn't going to be forced to accept terms that I didn't want to take or partner with somebody I didn't want to partner with just because I was desperate. And so while it is important to have passion in what you're doing, it's also very important to put systems in place or structures in place to support yourself so that you can grind through to see your entrepreneurial vision become a success. So those are sort of the two takeaways that I had, and this is why I'm super excited about what's going to happen going forward, and that's what Thin Line Capital is all about.
Great. Okay, so thank you for that amazing presentation. You really did cover not just the different spaces and markets, but also over time, which I didn't know any of that history. And it's also just kind of nice to see that we're trending in a direction that is more sustainable, whether it's by force or by choice. These industries are going to have to fall into line, or are they? So I'll start with a question. We do have a question from the group with Matt Wade. Everyone, please use the hand raise function for questions so that I can kind of call you guys out. My first question, and then I'll pass it to Matt, is, you know, they say a lot of what I read about the clean tech space is that the space is bigger than the number of players currently working. So there's just so much room for new players in the clean tech space. But there are also these really big players. And so sometimes it's hard for startups to kind of break into places where, you know, there's just these huge players that can eat up and move a lot quicker because they have the funds to do so, all the different opportunities. So what would you say about that for the students or anyone who's interested in entering that space? Is that something to be worried about, or is there enough space for everyone, or, you know, are these big companies not going to be able to manage?
So the dynamic is a little bit different. So people think of, you know, Google as a startup success, you know, and it clearly was. But those media companies, Google for internet search, Facebook for social media, they were actually a better example might be Expedia. So you know, there was a time when there were things called travel agents, and you wandered down and sat in a brown chair and flipped through some pamphlets, and they're all basically gone. You know, online, you know, travel agents, Expedia or Kayak or whatever, completely destroyed those companies. So there's this thought that startups have to do that. That's what being a startup is. You enter and you crush the existing companies. But the truth is, in the energy space, that's not likely going to happen. There is one startup car company that is now, you know, changing the world with electric vehicles, and it was started by, you know, I don't know if Elon Musk was a billionaire when he started it, but he basically went all in. I mean, he took his, you know, hundreds of millions of dollars that he had from PayPal and just put all the chips on the table. And in fact, he was borrowing money from friends until Tesla went IPO. If that's the hurdle, then we're screwed. If to have startup, you know, like to be a successful clean tech entrepreneur, you have to have A, hundreds of millions of dollars, and B, you know, be Elon Musk, then we have problems. But we don't have to do that. The fact is, Tesla is a huge anomaly and a massive success. But the way startups will play is, and this is what's different a bit than internet companies, is there is participation everywhere along the scale, all the way from ExxonMobil at the top end, all the way down to a startup. And so I see a lot of opportunities for one of the companies I've invested in is a software platform that enables EV manufacturers to better manage quality control of batteries through their supply chain. Great. GM, Ford, Daimler, like, you know, all these companies that are moving to electric vehicles, just like large companies adopted Salesforce.com, you know, Salesforce wasn't trying to, I don't know, you know, overrun everyone's business. They were trying to support everyone's business. I think for startups, it'll be much more along those lines of supporting really big companies that want to go after these markets. So the oil companies are inevitably wedded to oil, although the 3 board members on Exxon are pushing that, hey, we're an energy company. And it's true, the oil and gas companies can do big energy projects, big zero carbon projects better than anyone else could just because of their scale. They just happen to be currently wedded to oil. But car companies, people think like, well, car companies just want to sell cars. Like they don't really care about emissions. They're more than happy if they're going to make way more money selling EVs to go do that. So I think there's going to be a transition. Yeah, there's some really big companies, but the entire economy at all levels are moving to adjust to this, and startups are going to play a role, but it's not like, oh, we need a startup to become the next ExxonMobil. That's not how this is going to play out. In fact, that was the mistake of 10 years ago with Cleantech. Everyone thought, oh, startups should be solar manufacturers, which was insane. What happened is solar manufacturing, China turned on the big manufacturing machine that is China and drove solar costs down. That's okay. I mean, that's absolutely enabled this transformation in the energy industry, but there will be multiple players in addition to startups who make all this happen.
So I guess your advice would be, to look to kind of solve the problems of the bigger kind of players now in a way so that you're not okay.
So the biggest risk of anyone in this space is not competition, but the competition of non-consumption. Selling to utilities, selling to automotive companies, this is a very difficult path forward. So I've seen a number of really successful startups that are targeting the consumer space, educating consumers on how to, buy more intelligently or whatever. So the most important thing, a lot of VCs talk about, the most important thing is market size, and you want to be in a really big market. And while that is true, I sort of think that one of the most, since all of these markets are just infinity, I mean, they're all huge, the better metric is ease of market adoption. If you have to get some kind of regulatory approval and then get GM to become your sole, their sole supplier or anything else, that's probably a very, very difficult path to market. So the primary goal is to look for a market entry point that you can serve. So an example, this company doing work with EV companies, started off by serving cell phones, battery manufacturers, because the commitment to provide quality data for batteries for cell phones was easier to get into. Then they built up their big platform, and then they pivoted to EVs. So I don't want to say, hey, make big, slow incumbents your customers. But I'm definitely saying, don't try to, yes, Tesla built a company to compete with Ford, but I wouldn't suggest that startups should say, I'm going to build a car company. That is not a very easy path. And there's lots of ways to play serving existing companies rather than trying to become one.
Got it. Great. Okay, I'm going to ask Matt to go ahead and ask his question. Oh, did he just pop off?
No, he's there.
Okay, hey, Matt.
But you're muted.
Thanks, appreciate it. Thanks so much for the awesome presentation. And I was certainly wowed by a lot of the trends that you identified. I just had a question about how you're thinking about the energy transition in terms of the rare earth minerals that are going into batteries. And it seems that we have this huge transition that's based on, capturing energy and battery power. What do we do about non-renewable rare earth minerals? Thank you.
So there's a couple of things for that. Part of me is a bit suspicious that there's a bit of like FUD, fear, uncertainty, and doubt. Like, oh, hey, we're going to run out of lithium one day, so let's not even do EVs. And I've been in this industry enough to step back and go, okay, so who pushed that narrative? Because that's someone who doesn't want EVs. Nevertheless, there is a finite amount of lithium in the world, and so there's a concern about that. There's already been a big push by a number of companies, including Tesla, to make batteries with much lower cobalt loadings than existing batteries. Cobalt's also part of the supply chain that's of issue. So there's a couple of angles for this. One is lithium is right now the dominant battery for mass and volume constrained applications. So if you're going to stick it on something with wheels, or God help you, with wings, it needs to be small and light. But all that grid scale storage that I was talking about for the grid, that can be bulky and heavy, and who cares? I mean, a giant pumped hydro facility, the footprint of Hoover Dam is pretty large, but it's great for the grid. So Energy Vault, for example, is a gravity storage company competing with pumped hydro, and it's not mass efficient at all. And so hang on a second. So I think there's going to be a lot of solutions available that don't require lithium batteries. And so the second thing, though, going to speak to batteries, is that I've seen a lot of technologies that, goodness, I don't know what's going on here. Here.
How is, can you still hear me?
Yeah, we hear you just
Yes.
fine. Were you having audio problems?
Speaking of batteries, literally just died on the wireless thing at the same time. So there are a bunch of ways that there is an enormous amount of lithium stored in seawater. It's at very low concentrations. And as the price of lithium expands, because people look and say, well, so, you know, what happens when we have all of Bolivia's lithium? It's not economic today to mine lithium from seawater, but there's a bunch of people working on that. In addition, if you combine it with, say, desal applications, so you desalinate the water to get fresh water, and then you have this brine left over, which therefore the lithium's concentrated. So I actually feel that lithium batteries are not going to be the solution for all of storage. I think it'll just be electric cars. I think large scale, like shipping, moving away from bunker fuel, will be done with fuel cells, because you can store so much more energy with hydrogen and a fuel cell rather than with trying to run a ship off batteries. So not everything will be batteries. The things that are batteries, there are other alternatives for finding lithium. There are ways to reduce the consumption of rare earth materials. And the final one is the CTO of Tesla, JB Struble, has left Tesla and started a company for recycling batteries. Because of course he sees the chart that it's like, wait, shift this thing 10 years. Every single one of these vehicles we sold is going to be this massive stockpile that we can mine for, the materials we need to make new batteries. So I think there's going to be a big push in recovering those materials. Similar with the platinum loadings of fuel cells, the platinum is not actually consumed. It's just a catalyst. If you can recover that and reuse it. So I in a sense, I feel that the market drivers are going to push towards these solutions, and then people are going to figure out how to solve them, because there's just a staggering amount of money to be made. But that's kind of how I see it'll happen.
Thanks so much.
Great. Okay, I'm going to pass it over to Alana. Go for it.
Hey.
I have two, I think, short questions, I hope. Like the first one was, do you think hydrogen cars will like compete with electric cars for like consumer level cars? And then my second question was, like, for divesting from fossil fuels, like USC like just did that, but it took like years of like environmental clubs activism, and it only really happened because we got a new administration. And it's really just like impossible to like, ignore the necessity and the feasibility of divesting and like reinvesting into electric options. But as far as like the companies that, prevented such change from happening for decades, and now they want to like, play a role in it, how do you think they like do that like ethically, and, where's the like kind of accountability there?
Yeah. So the first question is, Toyota is not interested in electric cars, even though they made the Prius. They were like the leader. They're all in on hydrogen. And I don't really get that. I think that the argument is that hydrogen fuel cells are better than batteries on a mass energy density basis, which is true. But the truth is, that's not how technology works. The technology works when things are good enough. Then once they're good enough, people switch. And EVs are good enough. Like the range of an EV, people used to worry about range anxiety, and you can only drive 70 miles and all that stuff. I have a Model 3. I guess it goes 200 and something miles. I don't know. I don't drive that far. I guess if I drive to Santa Barbara, I have to think about it. But the point is, and that's the low end, it's just getting better and better. So I kind of feel that EVs for passenger cars and trucks is going to win over hydrogen. For long haul shipping, like long haul trucking, and I know that Tesla has an EV truck, that I'm not so sure about. When you're going like really far range, then I think hydrogen then wins. And I totally think like locomotives, like trains and ships, hydrogen makes like way more sense than trying to do anything with batteries. For aviation, I think short scale, like propeller planes, there's a number of companies, there's like 3, I think, that are doing batteries. It actually makes more sense than I thought if the range is low enough. But for long haul, some kind of blended jet fuel with biofuels, like synthetic, like you suck the carbon out of the air and you literally make jet fuel, but it's carbon neutral. I think that's that approach. Now, second question is super interesting. So CalPERS is one of the biggest funds in California. There's a California Public Employees Retirement something. I guess the S stand for something. But anyway, I asked them, I was at a conference with one of the, I don't remember whether she was the chief investment officer, but someone very senior in CalPERS. And I asked her about divesting from oil and gas and the ethical considerations and everything else. And she had been around during the apartheid crisis with South Africa in the 80s. And she was saying, it's very similar. Everyone was like, that's it, completely divest from South Africa, sell everything South African. We're not involved at all. We cannot support a country that is engaging in apartheid. And so we need to divest. The problem was, as soon as you sell all your shares, like you're out. You have no influence. You have no way of making change happen. The Exxon argument, engine number one, bought a bunch of Exxon shares so they could find a way to cram 3 people on the board. And then through those board seats, change Exxon. So I never really thought of it like that before. If I think oil and gas stocks are going to go down, and I had this, I lost a whole bunch of money in my 401k in oil and gas stocks. And I thought about it, maybe I should wait till they recover, and then realized my entire career, my mission is to make those stocks worth 0. So you know what? Suck it up and sell them, because my job is to make them worth less. So I did, and that sucked. But I'm not on the board of Exxon, and I do not have $100 billion to play with. And so large scale endowments have a more tricky ethical situation. Yes, from an investment point of view, they should get out of oil and gas if the price is going to go down. But it's not so obvious from an ethical point of view of getting out entirely, because then they no longer can make those companies behave better because they're not on the board anymore. They're not involved anymore. So I don't fault USC for doing that. But when the apartheid example was brought up about why a bunch of companies who took a lot of heat still being still being big shareholders in South African companies, it actually made a lot of sense to me why companies that want to change the world to be better may own a lot of shares in a company or in a country or whatever that isn't doing what you want. So anyway, that's just a nuance that I hadn't fully appreciated. And so anyway, I just thought I'd mention that.
Great answer. It's, it's interesting because there are probably lots of different ways to get big companies that to think more laterally in terms of how they plan on generating solutions to the problems that they face, and not necessarily kind of lumbering forward in the same way that they always have. Being on the board is probably the fastest and easiest way to do that. But I imagine there are probably other ways to apply that pressure, but it is a very interesting point.
Yeah, like Exxon, selfishly, everyone just wants to make money. Exxon isn't particularly thrilled about, they also don't seem to care about climate change, but they care about making money. And if they're going to make more money worrying about climate change and less money by just being a dirty oil company, they will change. But more to the point, they will do what their shareholders want them to do. Well, if everybody sells Exxon stock, so the only people who hold Exxon stock are people who don't care about the environment, then guess what? Exxon's not going to care about the environment. So it's a weird dynamic that only matters if, by the way, if you can afford, like 10% of Exxon. So it's a problem you have when you have tens and hundreds of billions of dollars that you control. So it's not your average person's moral dilemma, but it is an interesting one.
Okay, so I do have some lined up questions. We have Cervantes and then Menachem, and then I think David Gerber has a question, but we're hitting time, Aaron, and I just want to be respectful. Are you okay to stay over to answer these questions?
I can stay till 10:02. So yeah,
Okay.
I can give you, I have to prepare for something at 2. So I can, yeah, for like whatever that's 17 minutes or something. Sure, happy to.
Yay, okay, great. Cervantes?
Yeah, thank you so much, Celia. Hey, Aaron, thank you so much for the presentation. It's more like economic history class. And then my name is Cervantes Lee. I'm USC education doctoral students. So I'm wondering about the, even we talk about clean tech as a practitioner like you, but how about the household? How do we educate a young professional? Even I can educate my mom. How would you make our home more sustainable? So as a practitioner, would you have any suggestion? And then other than just buy Tesla car, I just want to learn from your thought, how do we educate the sustainability, clean tech to the regular people? Yeah, thank you.
That's always a hard question. And I've never had a good answer. People say, well, what can I do about climate change? And the reason I struggled with it, and somebody brought up, which I thought was a really great response, which is like, well, hang on, why is that our responsibility? I mean, the corporations that are providing solutions for consumers are the ones that need to, they're the ones that need to make the biggest change. It's sort of like in California's drought, I'm not allowed to water my lawn. And I agree that conserving water is important. However, I feel like saying, like, can I just put up a sign that says I'll have one less steak and that will buy me a month of water? Because I don't know if you know the water consumption of a steak, but it's literally like a multi-hour shower, right? I mean, like, it's no comparison. So the vast majority of water consumption in California are farmers. And they're not even ones producing, yummy steaks. It's like, I think it's like a gallon of water per almond, things like that. So, we need the right pricing mechanisms in place. And it's sincerely a role of government, because by definition, a government is how an aggregate group of citizens invokes change, rather than like one person at a time, buying like an Arrowhead water bottle that has a slightly smaller cap, saying that that's green. So, so that's sort of my, kind of gripe on that. Now, the good news is, Mark, people are changing dramatically. And it's not just a Tesla. Like I said, there's like literally every car company is coming out with electric vehicles, and most of them plan to completely phase out internal combustion engines by 2030. Not only will they come out with an EV model, they will not have anything but EV models like within 10 years. And renewables are becoming really cheap. So if you don't care about anything other than saving cost, which utilities are well in that camp, they're highly regulated and highly structured to basically buy whatever is the most cost-effective solution. Well, that's why renewables are blowing up, because that's what people are buying. And it's funny, and you talk about, encouraging young people. That's also not something I'm really that concerned about, because young people are really, really motivated about these opportunities. I do give talks about, like, a larger talk about climate change to various schools and things. And, I say, like, look, the only complaint is, well, what if I don't want to be an engineer? Because this mentality is like, it's all STEM, science, technology, engineering, math. And I'm telling people, like, look, if you want to know about infectious diseases, that's going to be important. If you want to know about policy, that's important. If you want to be a freaking property developer and build cities that don't have people commuting for 2 hours, that's important. Like, it's humanities, it's science, it's medicine, it's law, it's journalism, like telling people, because this is not a technical problem. Climate change is not a technical problem. It's this weird collective psychological experiment. We could have solved this back in the 70s if everyone had just collectively shifted. So there's a huge amount of interest in participating, because people see that this is like, going to affect them dramatically. But B, it's an area with massive amounts of growth, and anyone starting their career wants to go into an area with massive amounts of growth. But it's not entirely, there's a mistake that this is an engineering science, thing. And people don't realize, like, look, throw a dart at a list of careers and I could, no matter where it lands, I could tell you why there's a connection to climate change. So, yeah, I think I answered like 7 of your questions. So hopefully that was helpful.
Great. Okay, Menachem, are you still there?
Hi, yes, hi. Thanks, Aaron. It's been a really interesting talk. I just had one question about the how clean is clean energy. Referring to the manufacturing process and recycling, but mainly the manufacturing process, because a lot of these ways of creating energy actually are really not clean in the process of making them and building them. So I just wanted to talk about that a little bit.
Yeah, no. If you look at, and I don't think it was the latest IPCC report, the Intergovernmental Panel on Climate Change. I think it was actually the one prior. They had this really cool analysis of lifetime emissions. Like what are the emissions from a solar panel? Well, like 0. Like, there's nothing. You just plug in some wires. Yeah. But you got to, you got to build the silicon ingots and you have to extrude them and you slice them. And basically, like you were saying, manufacturing. And then there's, of course, the waste of like, okay, great. You've got this like thin sheet of silicon, which sits on a roof for 30 years, but then what do you do with it? So they did this really cool life cycle analysis. And yes, clean energy is still like massively better than, fossil generation. Not even counting CO2 emissions, but heavy metal pollution out of coal plants into tailings ponds and a variety of other things. So like for one really good example, for example, is hydropower. A lot of hydroelectric dams were built by building the dam and then just flooding the valley. There's a bunch of Native American villages that are underwater when Lake Mead was formed with Hoover Dam. I mean, they just built the dam and said, screw it, and made Lake Mead. Well, in areas that were heavily forested, all of those trees are underwater. And then they, in some cases, rot, unless it's in like a completely oxygen-free environment. And then rotting trees release methane. And if you have an entire mountain of trees releasing methane, maybe that hydro dam isn't so clean. And the cool thing is with that analysis, like takes that stuff into account. And by the way, still hydro is like still even factoring in the methane emission releases is enormously clean, slightly dirtier than say solar, but way better than fossil generation. So while there are issues of manufacturing, it's mostly solar, although wind power is, again, you're building this giant steel turbine that's, like 100 meters long and stuff for each blade. The overall, the reduction in, say, mining of coal or extraction of oil and gas, especially gas, the what's called fugitive emissions, the methane release, not the burning of the natural gas, just the leaking methane in the supply chain to get it to customers. That completely dominates the emission profile, and the manufacturing, the environmental penalties of making batteries and making solar panels and everything else. Yes, I suppose you should not. You should reduce not call it zero emission technologies. Although there in itself is interesting. If it takes an enormous amount of electricity to build a solar panel or wind farm, and most of that electricity comes from coal, then you say, hey, look at how much emissions a solar panel has because it uses so much electricity. It's like, well, yeah, but as the grid moves to be completely zero emission grid, the electricity used to build the solar panel in the first place goes down in carbon content. So criticizing a solar panel for its electricity consumption that was created by burning coal as evidence that we should not make solar but continue to use coal is a flawed argument. I'm not saying that's the argument you're making. I'm just saying that one is flawed. So, so I would agree. None of these they are zero emission when producing energy, producing electricity. They are not zero emission over their lifetime, but those emissions are still dramatically less than any other kind of traditional energy generation. And so that's sort of the metric that matters.
That's a great answer. Okay, last question from David Gerber. And then I'll do some housekeeping after that. Go ahead, David.
Aaron, thank you very much. Sorry for any background noise. I'm in the middle of Cedar Sinai. I want to shift gears away from, in a sense, cars and transportation, and squarely get your brain on the fact that the built environment, buildings, account for about 48 to 49% of GHGs. And so there's a two-part question really, which is, what's your sense for how we can really rapidly change that part of the economy and culture? And then secondly, and it's more of a investor specific question, which is, how would you recommend a startup like us, which is developing road mapping process and technology, a SaaS for helping people achieve sustainability in their built portfolios? So first part is, how do we get people to focus on the building? Second part is, how would you guide a SaaS startup with very, very deep focus on road mapping and sustainability?
So you're right. The built environment is huge, and most people don't think about it. To be fair, I knew of it, and even I didn't fully appreciate it. The best book I can recommend is Bill Gates's book that he recently published, because he basically does an inventory of, like, these are where emissions are coming from. And he does it probably in the best way I've ever seen anyone do it. He's Bill Gates. I'm sure he could hire all the help he needed, but it's a really well done book. And it basically points out that it's like, yeah, EVs are really important. They're a huge amount of emissions. They're 15% of our emissions. And that just blows people's minds. Like, wait, what? Like, all the cars on the road is like 15%? And the answer is, yeah, kind of. Like, and I totally talked about coal and EVs and everything else, and it's a huge chunk, but it is not what it takes to build steel and concrete. And the reasons for that are fundamentally literally baked into the chemical equations for making concrete or making steel. And so not only do they use an insane amount of energy in terms of heat, which you can decarbonize by producing that heat from zero carbon sources. So I mentioned I'm the founder and CEO of Heliogen. A big part of what Heliogen is doing is going to industrial heat consumers, because their only other choice is burning methane, burning natural gas, and going and saying, look, we'll give you 1,000 degrees C heat emission free. So that takes out all the energy related emissions from the product, but it doesn't take out the chemical embedded emissions from the product. So there are other solutions for that. There's a Caltech company. I saw them 4 years ago. But anyway, they just joined Caltech's rocket fund called Brimstone, and they're using things with sulfur. And there are a number of other low carbon, low CO2. I mean, all you care about the end product being something strong in compression and super, super cheap. That's what cement is. It's like dirt cheap and really has great compressive strength. And then steel has got the same requirement, but tensile strength. So steel has to pull well and concrete has to push well, and that's it. And be super, super cheap. So there are a lot of people working on materials changes to try to solve that. Thin line is not doing any of that stuff. I just don't have the capacity to back companies like that, because they usually require more capital.
Huge amounts of capital.
Yeah, I don't have a fund for that. Breakthrough Energy Ventures does. Bill Gates's thing, multi-billion-dollar fund. They totally go after that stuff because they can. So anyway, but a SaaS company, that's more what I focus on, because software is much more capital efficient and it works for a smaller fund. I guess it depends ultimately any startup. The question is, okay, so like who, and this, I spent some time with iCore via USC, and there's sort of three really great questions, which I've totally stolen directly from iCore, which is like, what do you do? Who is it for? And why did they care? And I'm like, that is perfect. because people would stand up and say, yeah, we've got this like micro nanofiber material with porous blah blah, and you're like, yeah, what? Who is it for, and why do they care? Well, it's got 20% more pores. Yeah, but like, why? Why do they care? Like, oh, because it reduces cost or something like that. So I guess the way I would position any company is try to figure out the why do they care to adopt your technology. And if you can give them a way of demonstrating CO2 emission reductions, like in some accountable way that they can then use to either meet compliance requirements or sell those credits, that's way more valuable than just we help companies cut their CO2, like as an example. So the real thought is like, why would anyone adopt what you're doing? Because the reason that they would adopt, the reason why is the thing you have to do super well. So if you kind of can get in the headspace of your customers and say, why would they ever adopt our technology? If you really have a good answer to that question, then you know exactly what you need to do better than anyone else, because that's the reason they're going to adopt your technology. Oh, and then you, by the way, you baked in a great pitch for investors because now you can answer those 3 questions. So I find that the hardest part of a startup, especially in the energy space, is initial customer acquisition, especially customers who are like utilities and automotive companies who are slow and conservative and they don't, buy stuff from startups. So really figuring out how to get a beachhead market and using that to prove that you do what you say you do, which allows you to march yourself up the value chain to bigger customers, is super important. But then being able to communicate that exact same vision to investors is how you can get investor interest. So that's kind of a generic answer, but
no, that was very helpful. Actually,
okay,
perfect answer, Aaron. I really, really appreciate it. Thank you very much.
Excellent,
and thank you, RC, as well.
Yeah. Well, that's a very, very special thanks to Aaron because he stayed over and answered all these questions. This has been the most, I would say, engaging back and forth questions that we've had for our summer semester speakers thus far. So clearly you are in a very interesting space where lots of the students and the teams on, would like to continue to engage with. So maybe this is my way of asking you to come back again soon because there's definitely
it's my second one. I could always do a third.
So I will say goodbye to you, Aaron, because I know you have to go right.
I gotta drop off.
Housekeeping. Bye, Aaron. Thank you so much.
Bye. Glad I could do that. That was fun.
Yep. So everyone who's still on the call, I just want to remind you that next week we have actually, Aaron Fyke, he is with Wavemaker. And so is our next week's speaker, but he's in the healthcare space. It's Jay Goss. I don't know if you guys can see his whole thingy here. And that will be next week, same time, Wednesday, 12:30 Pacific time. So hopefully we'll see you all there. And then I will send out an email to the Summer Smasher students about tomorrow's lab. We will be not having a lab tomorrow because David Gerber will be traveling. If you guys want project support help or want to do something in terms of your projects, please meet up on Slack. Use the hashtag Summer Smasher 2021 channel to ask and answer all of the questions that you might be having with your projects this week. So nice to have everybody. Hopefully I'll see you guys all again next week, Wednesday. Bye.